Only 1 in 4 retirees feel safe. I'm here to help your $750,000 last, not vanish. Only 1 in 4 retirees feel safe, and I get why. If you've got $750,000, a generic set-it-and-forget-it plan can turn into a trap fast. Hi, I'm here with you on this, and the first thing to know is simple. Retirement is not a math class, it's a timing game. The same portfolio can look strong on paper and still fail in real life because the order of returns matters, and bad years at the start can do more damage than bad years later. That's sequence risk, and it's a silent killer. Here's why the classic 4% rule can be too rigid. On day one, 4% sounds neat. Pull $30,000 a year from $750,000 and move on. But life doesn't care about neat. If the market drops 20% in your first 2 years and you keep withdrawing the same amount, you're selling more shares at lower prices. That means less money left to recover when the market bounces back. It's like trying to fill a bucket with a hole in it. The early hit is the one that sticks, because every withdrawal after a loss comes out of a smaller base. Then inflation comes in like a quiet thief. A $30,000 withdrawal today won't buy the same groceries, gas, or healthcare 5 or 10 years from now. Even a 3% inflation rate cuts purchasing power in half over about 24 years. So if you never adjust, your lifestyle shrinks without warning. That's why retirement planning is not just about earning more, it's about protecting what your money can actually do. And taxes change everything too. A $30,000 withdrawal from a traditional IRA is not the same as $30,000 from a Roth. One may be taxed, the other may not. A taxable account can create capital gains too. So the real question is not, how much did I withdraw? It's how much did I keep? Different account types, different tax bills, different outcomes. That's why a $750,000 portfolio needs balance, not blind rules. You want growth to outpace inflation, income to fund life, and capital protection so one bad market doesn't wreck the whole plan. In retirement, the win is not the highest return. The win is making your money last. If you had to spend from a $750,000 portfolio for the next 20 years, would you want one big pile of money or 3 separate buckets with clear jobs? I'm going to show you the bucket method because it turns a scary question into a simple system. And in retirement, simple beats clever almost every time. Here's the idea. I divide the money by time, not by emotion. Bucket 1 is cash for the next 1 to 2 years of spending. Bucket 2 is bonds for years 3 through 7. Bucket 3 is long-term growth for anything you do not need soon. That means the money you need next month is not sitting in the stock market, and the money you need in 10 years is not trapped in a checking account earning almost nothing. Each bucket has a job. Cash is the shock absorber. Bonds are the bridge. Stocks or balanced funds are the engine. For a $750,000 portfolio, a practical example could look like this. About 1 year of spending in cash, about 5 years in high-quality bonds or bond funds, and the rest in equities or a balanced growth mix. If you spend around $60,000 a year, that might mean roughly $60,000 in cash, around $300,000 in bonds, and the remaining $390,000 in growth assets. That split is not magic, but it gives you breathing room. When the market is down 20%, you are not forced to sell your growth bucket at a bad time just to pay the electric bill. That is the whole point. Less panic, less damage, more control. Think about the emotional side for a second. When stocks fall, a lot of retirees do the worst possible thing. They sell low because they are scared. Buckets help stop that. Your short-term cash says, relax, you have time. Your bond bucket says, we can wait. Your growth bucket says, keep working. It is like having 3 lanes on the highway instead of 1 crowded road. If one lane slows down, traffic still moves, and that matters because bad decisions in a downturn can cost more than the downturn itself. One money lesson I always repeat is this. Your plan should calm you down before the market can scare you. The refill process is just as important. After a strong market period, when stocks or balanced funds have grown, I would refill the cash bucket first, then top off the bond bucket. In plain English, you harvest gains from the bucket that ran ahead and restore the bucket that protects your next few years. That keeps the system balanced over time and forces you to do something many investors never do: sell high on purpose. If the market has been kind for 12 or 18 months, that is your chance to restock. If the market has been rough, you let the cash and bond buckets do their job and avoid turning a temporary drop into a permanent loss. So the bucket strategy is really about one thing: matching money to time, near-term spending in cash, medium-term needs in bonds, long-term growth in equities. That structure reduces stress, reduces forced selling, and gives you a clearer head when headlines get loud. If you want, comment bucket plan, and I'll map out how this looks in the next step with exact percentages and withdrawal flow. What if I told you a retirement portfolio can pay you without living on dividends alone? I'm talking about a system that works even when one piece is quiet, and that matters because I've seen too many people treat yield like the whole story. Total return is the real engine: growth, dividends, and interest all working together. Think of it like 3 lanes on the highway. If one lane slows down, the car still moves. That's why I'm not building a portfolio that begs the market for cash every month. I'm building one that can create cash on purpose. Here's the difference. Income generation means the portfolio throws off money naturally. Total return spending means you take withdrawals from the whole portfolio, whether that cash came from bond interest, stock dividends, or price growth. So yes, high-quality bonds can provide steady interest. Dividend growth stocks can raise payouts over time. Broad index funds can give you long-term appreciation plus some dividends. But the key is this: you do not have to force the portfolio to live on income only. A smart withdrawal can come from any bucket, not just the bucket that paid you last quarter. And this is where people get trapped. They chase yield, then wonder why the portfolio feels shaky. A 9% yield can look sexy on a chart, but if the company is weak, the fund is risky, or the bond is junk, you may be buying trouble with a pretty label. I've seen investors reach for income and end up with less safety, less flexibility, and more stress. That is not retirement freedom. That is just a different kind of job. The rule is simple: don't optimize for the biggest check, optimize for the longest-lasting plan. Big yield is not a victory if it breaks the machine. A better move is systematic withdrawals. Maybe your bonds cover part of the spending. Maybe your dividend stocks cover another slice. Maybe in a strong year, you sell a small piece of an appreciated index fund instead of chasing a fatter payout. That can actually be smarter because you're selling what has gone up, not buying more risk just to collect a higher distribution. In a year when stocks are up 12% and bonds are stable, taking 4% out of the total portfolio can be cleaner than hunting for 6% yield and stepping on a landmine. And when markets are weak, you keep a withdrawal ceiling. You give yourself a limit so you don't drain the portfolio at the worst possible time. Lower withdrawals in bad years can protect the next 10 years, not just today. That is the quiet power of a flexible engine: steady, simple, and built to last. A 20% market drop can feel like a disaster, but the bigger disaster is selling after that drop and locking in the loss. I'm talking to you like I'd talk to my own family. Retirement is not just about earning returns, it's about avoiding bad decisions when the market gets loud. That's why this portfolio uses guardrails, not panic buttons. If stocks fall hard, the first move is not to dump everything. The first move is to check the spending rule. A temporary 5% to 10% cut in withdrawals can give the portfolio breathing room, and that one move can protect years of future income. Small sacrifice now, bigger stability later. That's the trade. Here's the simple logic. Keep a reserve bucket, maybe 1 to 2 years of spending in cash or short-term bonds. When the market crashes, you live off that bucket instead of selling stocks at the bottom. It's like having an emergency bridge so you do not jump into a river during a storm. Then, once markets recover, you refill the bucket by rebalancing. That matters too. If stocks have grown too much, you trim them back. If they've fallen, you buy them back at lower prices. Rebalancing forces discipline when emotions want chaos. Buy low, sell high,
repeat. That's the engine. Now let's talk about inflation, because a portfolio can survive a crash and still fail if prices keep rising.
A retiree who stays too conservative may feel safe in year one, then slowly get squeezed by groceries, rent, and healthcare. A 3% inflation rate cuts purchasing power in half in about 24 years. So this portfolio still needs equity exposure, plus inflation-sensitive assets like TIPS, dividend growth stocks, and maybe a little real asset exposure. Not gambling, not swinging for the fences, just enough growth to keep pace with life. That is the balance. Protect the downside, but do not starve the upside. And this is where longevity risk comes in. If you live longer than expected, a too-safe portfolio can become its own trap. I've seen people hide in cash because it feels comforting, then wake up 10 years later with less real income and more fear. That's not prudence, that's slow erosion. The goal is durability, not dormancy. So the rules stay flexible. Cut spending a bit in rough years, avoid forced selling, rebalance on schedule, and keep enough growth in the mix to fight inflation. In retirement, the real enemy is not just volatility, it's the combination of fear, time, and bad decisions. If two retirees both start with $750,000, why does one money pile feel like it lasts forever while the other starts shrinking fast? Hi, I'm your guide here, and the answer is often taxes, not just returns. A portfolio can look healthy on paper, but if every withdrawal triggers avoidable taxes, your nest egg leaks money like a bucket with tiny holes, and those holes add up. The rule is simple. What you keep after taxes is what funds your life. Here's the easy map. Taxable accounts are the most flexible. You can sell when you want, and you may get long-term capital gains treatment, which is usually friendlier than ordinary income. Traditional IRA and 401k money is tax-deferred, so every dollar you pull out is usually taxed as income. Roth money is the cleanest. Qualified withdrawals are tax-free, which gives you breathing room later. That difference matters because the same $40,000 withdrawal can land very differently depending on the account. Same withdrawal, different haircut. That's why smart retirees don't just ask, "How much can I spend?" They ask, "From where should I spend it?" A practical order is this. First, use taxable accounts, especially shares with low gains or harvested losses, because you control the timing. Next, tap traditional accounts in a way that keeps you in a lower tax bracket, especially in years before Social Security and before required minimum distributions, or RMDs, start. Save Roth money for last, or use it strategically for a big tax year, a market drop, or a surprise expense. That sequence can stretch portfolio life because it reduces the tax drag that silently eats your withdrawals. Money saved on taxes is money that stays invested longer. That's the whole game. RMDs are the big trap. Once they begin, usually in your early 70s, the government forces money out of traditional accounts whether you need it or not, and that can push you into a higher tax bracket, raise Medicare costs, and make the withdrawal plan less flexible. So I want you thinking years ahead, not just month to month. A little planning before RMD age can save a lot later. As the saying goes, a tax deferred is not a tax avoided. In taxable accounts, tax loss harvesting can help too. If a fund is down, you may be able to sell it, lock in the loss, and use that loss to offset gains. And if you hold a winner for more than a year, long-term capital gains are often taxed less harshly than short-term gains. This is where asset location comes in. Put tax-inefficient assets, like bonds or high-dividend holdings, in tax-deferred accounts when possible, and keep more tax-efficient stock funds in taxable accounts. Same portfolio, better after-tax result. That's not fancy finance. That's just making each account work in the right job. If you had $750,000 today, the first question is not, "How do I get rich?" It's, "How do I make this last?" I'm talking about a simple 3-bucket setup, because in retirement, buckets matter. Imagine this: 12 months of cash, 3 to 5 years of bonds, and the rest in stocks. That's not a wild gamble. That's a seatbelt. For a $750,000 portfolio, I'd start with about $75,000 in cash,
$300,000 in bonds, and $375,000 in equities. The cash bucket can hold high-yield savings, money market funds, or short treasury bills. The bond bucket can hold intermediate treasury bonds, short-term bond funds, or high-quality bond ladders. The stock bucket can be broad index funds, maybe a mix of U.S. and international stocks. Simple, clear, and built for real life. The golden rule here is this: cash pays the bills, bonds buy time, and stocks build tomorrow. Now let's make it concrete. Say you want to spend $60,000 a year, or $5,000 a month. Year one comes straight from cash. That means you are not selling stocks after a bad market drop, and you are not forcing bonds to do a job they do not need to do yet. Your cash bucket drops from $75,000 to about $15,000 by the end of the year. But that is fine, because the bond bucket is there to refill it. Around that same time, you can sell enough bonds to top cash back up for next year. If the market is ugly, you live on cash and bonds, not panic. If the market is strong, the stock bucket grows and gives the whole plan more breathing room. That's the point. One bucket spends, one bucket waits, one bucket grows. Stability, flexibility, dignity. By year two, you repeat the same rhythm. You refill cash from bonds, then spend cash again. Bonds are the bridge between today and the next few years, so they keep you from selling stocks at the worst possible time. Let's say stocks are flat in year two. Fine. Your spending still happens. Your bond bucket absorbs the shock. Then year three is where the long game shows up. If equities have grown, maybe that $375,000 stock bucket is now closer to $410,000 or more, depending on the market. That growth helps protect you from inflation, because groceries, insurance, and travel do not stay cheap forever. So the stocks are not there for a quick thrill. They are there to keep your future buying power alive. In plain English, cash handles the month, bonds handle the years, and stocks handle the decades. That's how a $750,000 portfolio can breathe instead of break. If you want this $750,000 plan to fail fast, here's how to do it. Park too much cash for too long. Panic and sell stocks after a crash. Chase some safe 8% product you barely understand. Ignore taxes and RMDs. And spend the same dollar amount every month no matter what the market is doing. I'm not saying this to scare you. I'm saying it because I want your money to last. Cash that sits there too long quietly loses to inflation. A stock sell-off in year one can turn a temporary drop into a permanent loss. And that shiny high-yield offer, if you don't know the risk, you're not investing, you're guessing. Here's the better move. When markets are down, trim spending a little. When markets recover, reset. That's the difference between a portfolio that survives and one that gets drained. Taxes matter too. At 73, RMDs can force money out whether you want it or not, and if you ignore that, the IRS will make the decision for you. The rich don't just own assets, they manage rules. That's the real game. Buckets, flexible withdrawals, and risk control can make $750,000 last longer and feel safer. Comment your age or question and subscribe for more.